In the meantime, a quick update on the U.S. futures picture. There was a lot to digest on Wall Street this morning. Let's start with U.S. growth measured through GDP. It was a bit stronger than expected in the fourth quarter. And here's what's interesting about that. It seems like that is signaling to the market that recession fears are easing. It's also signaling that there's potentially a lesser likelihood that you see interest rate cuts in the back half of the year, which some in the market have been predicting. But it's almost as if the narrative is really shifting now to whether there will still be growth as opposed to whether or not we'll see some kind of so-called central bank pivot. We also have lots of earnings stories that we are digesting this morning. We mentioned Tesla up on its profit strength. You got American Airlines and IBM out as well with their updates. More names after the bell like Visa and Intel. So there's a lot that we're going to continue to digest through the day overall. Let's get some more perspective on all of this, though. Kathryn Rooney Vera is the head of research at Bull Tick Capital Markets. Good morning to you. A very busy Thursday, Kathryn, at that.
Oh, yes. We've got some very good data out today. John, we got pretty good GDP numbers, a softening of consumption, but that really doesn't matter here in the U.S. because unemployment remains near 50-year lows, and disinflation is continuing. So things are looking good, and so far the earnings season as well.
And this, I'll tell you, this gets complicated because you hear people talk about recessions, you hear them talk about soft landings, you hear them talk about pivots. Maybe we can piece these different storylines together. So the data on the economy in the U.S. today would seem to lessen the likelihood that you, in the near term, see some kind of so-called pivot. And not to complicate it more, but here in Canada, I guess we're now at a pause point, which means rates stay where they are for now. We watch the data. The pivot is the idea that things are slumping enough that we need to reverse course and start cutting interest rates. If the economy still looks pretty healthy, maybe there's a lesser likelihood of that. But it seems like the market likes that idea, that maybe there's a higher chance of a so-called soft landing. Am I getting that right?
Oh, you could. Yeah, that's perfect. I mean, soft landing is this idea that the Fed can land 2% inflation from above 6 without inducing recession or without taking the unemployment rate from 3.5% to about 5%. So that's the ideal situation, and that's what the market is pricing in year to date. And that's why you're seeing this rotation out of defensives and into cyclicals. So all of the worst performers last year are doing very well so far this year. And that's because, in my view, it's a premature kind of market pivot, expecting that the Fed is going to achieve this miracle scenario of bringing inflation from a maximum of above 9% last year down to its target of 2% without precipitating a drop in demand. And that's still to be determined. And I'll finish with this point, John. I think that what the market is contemplating and internalizing here is that this perhaps is not an imminent thing. But as economists, we know that these are economic cycles, and likely the next phase of this cycle from stagflation is recession. The question is when. So maybe it's not right now, maybe it's not 1Q or 2Q, but recession is coming. And I think it's likely to come this year into next. So, and at that point, the Fed starts to cut.
No, that is very important context. And just for people who are trying to figure out, okay, we hear all these headlines. What does it mean for portfolio strategy? You've talked about defense with us in the past. And to your point about what's been happening so far this year, like if we look at the S&P 500, you've got these technology stocks, you've got some of these consumer discretionary names that have been defying a lot of buyer interest, less so in some of the so-called safety areas of staples, people not necessarily interested in healthcare. But looking at last year, Kathryn, staples in healthcare were a lot closer to the green than tech and discretionary were. So the market kind of changing its sector narrative, but are you, as a strategist, doing that just yet?
Not yet. And I think, and that's why last week I published a piece saying premature rotation, because the market is already pricing in and giving upside to sectors that historically outperform in expansionary periods. In other words, it's already discounting a recovery in the economy before the recession has even happened. So it's pricing in that we've reached the bottom. Last year, my top picks were the defensive. It was energy, healthcare, utilities, and staples. And in fact, those were the sectors that outperformed. And it wasn't a difficult call because one would see stagflation as the real scenario. We're in stagflation. The next step, in my view, is recession. So I think it's premature to jump into the mean reversion trade, which makes sense. I just think it's too early. And the mean reversion trade, John, is those sectors and those asset classes that got decimated last year. Small cap Europe, small cap US, real estate, emerging market equities, to name a few.